So how do you figure out what a massive commercial building is actually worth? Well, the answer used to be pretty simple. But what happens when its biggest financial risks are completely invisible? Let's dive in.
For the longest time, putting a price tag on a building was fairly straightforward. You'd look at the tangible stuff, right? Square footage, the quality of the build, and of course, location, location, location. These are the things you can literally see, touch, and measure.
But the world is changing. And suddenly, the biggest threats to a building's long-term value might not be the things you'd expect, like a leaky roof or some cracks in the foundation. We're talking about things like future climate events, new government rules on energy, or just what tenants are demanding these days.
And this is forcing a huge shift in how the pros value property. It's a whole new reality where what you can't see is suddenly just as important, maybe even more important than what you can.
Okay, so to really get our heads around this shift, we need to clear up a couple of key terms. You've probably heard sustainability and ESG thrown around a lot. And let's be honest, it can get kind of confusing. So let's just break it down nice and simple.
First up is sustainability. The easiest way to think about this is it's the goal. It's the big picture ideal we're shooting for. Running a building in a way that's not going to cause problems down the road.
So, if sustainability is the goal, how do we know if we're actually making any progress? Well, that's where ESG comes in. ESG is the toolkit. It's the framework valuers use to actually measure a building's performance on environmental, social, and governance issues. It's the report card.
So, to put it another way, think of sustainability as the destination you want to get to. ESG is the map, or maybe the GPS, that shows you how to get there, pointing out all the challenges and the best routes forward.
But here's the thing. This new map creates a real headache for property valuers. They're now caught in this really tricky balancing act between a building's value today and all of its risks for the future.
And this gets right to the heart of the problem. You see, market value, by definition, is just a snapshot in time. It's what a building is worth right now based on today's data. But in ESG analysis, that's all about looking into a crystal ball, trying to spot those long-term risks that might not hurt the price today, but could be a total deal breaker tomorrow. Here's a simple way to think about it. The market value of a brand new smartphone is easy, right? It's the price on the box. But a deep ESG analysis is like asking, hey, in 5 years, is this phone still going to get security updates? Or is it going to become a really expensive paperweight? That future risk totally changes how you see its long-term worth.
So how does an entire global industry manage this tension between today and tomorrow? Well, what do? You write a new rulebook.
And that's exactly what the Royal Institution of Chartered Surveyors, or RICS as you'll hear it called, has done. They've stepped in and put out a new global standard. It's basically a new guide for professionals everywhere, showing them how to factor all this sustainability and ESG stuff into their valuations. And the new standard makes it crystal clear. It says that considering these big ESG factors isn't just a good idea anymore. It is now a core part of how you determine value, period.
And here's the crucial point. The game has completely changed. Valuers now have to be able to analyze these super complex risks. We're talking about everything from understanding climate models to calculating the financial hit of new energy regulations. This is not optional. It's a mandatory part of the job.
All right, so there are new rules, but what does this actually mean for a building's price tag? How does some abstract idea like transition risk actually translate into cold, hard cash?
Well, it happens through a pretty clear process. First, a valuer identifies a risk, like, say, a new city law that's going to require a big energy efficiency upgrade by 2030. Then they estimate what those upgrades will cost. After that, they analyze if a greener building could maybe charge higher rent. And finally, they adjust the building's final value to reflect all of that.
So, for instance, a building that's a real energy hog might see its valuation get cut today because of the projected $5 million cost for a new HVAC system and windows in 5 years. That future cost casts a very real shadow on its value right now.
But, and this is a big but, it isn't always a simple price cut. The RICS guidance is very clear that not every risk automatically means a deduction. A potential problem might be too far in the future for today's buyers to care. Or, for a brand new, top-of-the-line building, its green features might already be baked into its premium price. This is where a valuer's professional judgment becomes absolutely critical.
And that leaves us with a really fascinating question for the future of real estate. As all these ESG factors become more and more defined, are we moving toward a world where every single building effectively has two price tags, one for what it's worth right now and a separate one for its long-term resilience? It's a shift that forces all of us to rethink what value truly means.